When going through my portfolio of holdings, there's one group of investments I have that have easily been one of the most controversial, which are my Pimco funds. As I've discussed in the past, I first started buying into these funds back in February of 2023 after their share prices had already fallen pretty significantly. Since buying into them though, their share prices have kept falling up until the past couple weeks where there's been a slight recovery in share price. But a handful of these funds, including PDI, are still down significantly since interest rates started increasing. So today I thought it'd be a good idea to check in on these funds and see how they're doing, what we can expect going forward, and if we're any closer to seeing a good recovery for these funds in share price. According to their website, Pimco currently has 21 different closed-end funds, and while a handful of them are pretty different from one another, like these state-specific municipal funds, the majority of these CEFs actually have a lot of similar holdings in them. So today we'll be focusing mostly on the larger, higher-yielding income funds. That would include the Dynamic Income Fund, ticker symbol PDI, the Corporate and Income Opportunity Fund, ticker PTY, the Dynamic Income Opportunities Fund, ticker PDO, and the Pimco Income Strategy Fund 2, PFN. I'll probably bring up some others, but like I said, these funds really aren't too different from one another. There are a couple differences in terms of asset diversification and the amount of leverage that they use. If we compare what these funds hold, you'll notice it's basically the same stuff. PDI, for example, holds a lot of agency and non-agency mortgages, commercial MBSs, high-yield credit, and emerging market debt among other holdings. If we then look at PDO, we can see, again, agency and non-agency mortgages, commercial MBSs, high-yield credit, and so on. The allocations differ as well as their leverage and also how much they invest outside the US, but it's basically similar stuff. You can see the same is true for PTY, PCM, and PFN. Where it can differ a lot is their holdings' average maturity date and the degree of leverage that they use. Some of these funds like PDI and PDO are currently using a lot of leverage, whereas PCM and PFM aren't using quite as much. If we turn our attention to the performance of these funds, we can see that some of these funds have been doing better than others with interest rates being so high right now. PTY is still down quite a bit from its all-time high in 2021 before interest rate hikes really took off, but it's still up over 30% since their IPO. PCM is still down a few dollars compared to its normal range, which I would consider to be around $10 and $12. The same could be said for PFN, which took a huge hit during the financial crisis, but has since been trading around the typical range of $9 to $12 per share. Out of these funds though, both PTY and PFM have suffered a minor dividend cut in our high interest rate environment. PTY reduced their monthly dividend by a little more than a penny, and PFN reduced their dividend by less than a penny. So although unfortunate, it hasn't really been too bad for them. But the two biggest losers would have to be PDI and PDO, which also happen to be Pimco's largest and third largest closed-end funds respectively. If we do a side-by-side comparison, you'll see that PDI is down 4.86% and PDO is down 8.26% for the year. But this doesn't take into account the dividend distributions. Because PDI currently offers a yield of 14.84% and PDO has a yield of 12.79%, we need to use a dividend reinvestment calculator. So far for the year, both funds have actually been in the green despite their share prices falling. PDI is winning with a yearly gain of 6.87%, whereas PDO is sitting at a 0.76% gain. I looked up every other Pimco fund that I've mentioned up to this point using this calculator, and all of them have a positive return for the year. So even though all these investments have been giving a positive return for the year, we all know that they've all been struggling to recover. The truth is, these Pimco CEFs have been facing some difficult challenges that have left people speculating for a long time that either their share prices will never recover to what they used to be in early 2021, or that a dramatic dividend cut is coming. So let's turn our attention to the two main causes of concern with these funds. The first is how interest rates affect the debt that these Pimco funds hold. I've mentioned this in previous videos, but the year 2022 was the worst year on record for the bond market due to the Feds raising interest rates so high and so quickly. There's an inverse relationship that exists between interest rates and bond prices. Most bonds pay a fixed interest rate that becomes more attractive if interest rates fall, driving up the demand and the price of the bond. If interest rates rise, then investors will no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline in its price. Because most of the holdings inside these funds are debt, it explains why their values have gone down so much. And if you're wondering what I was referring to when I said investors will no longer prefer the lower fixed interest from debt when these funds yield over 10%, it's because these funds use a lot of leverage. This is one feature that separates closed-end funds from your more traditional ETF and open-end mutual funds. Pretty much all of the higher-yielding CEFs out there use leverage to a certain degree, and these Pimco funds often use quite a bit of leverage. The reason they do this is to try to magnify the returns on these typically lower-yielding investments. But as you can imagine, there are pros and cons to using a lot of leverage. When times are good, leverage can boost returns significantly, but when times are bad, then losses can be significantly magnified as well. A lot of leverage mixed with the worst bond market in history was a recipe for disaster for these investment share prices, particularly PDI and the newer fund PDO. So in order for these funds to recover in value, what we'll need to see is a recovery in the bond market, but as you can imagine, what's been stopping this is high interest rates. Every time the Fed has been increasing interest rates, bond values have kept going down, so we really can't expect to see the share prices of PDI, PDO, PCM, and so forth rise until interest rates start getting cut. Fortunately though, the share prices of these CEFs have been stabilizing in the last couple weeks, as it seems clear that the Feds aren't interested in raising interest rates any higher. Some high-profile people in the markets, including Bill Ackman and Bill Gross, believe that the long-term treasuries won't go any higher and that going forward, we shouldn't expect any more interest rate increases. So that's the first issue that these funds have been experiencing, and like I said, in the past couple weeks, their share prices have been stabilizing a little bit, so we can only hope that this trend will continue. But there's also been another serious concern, which is how safe the dividend distributions are. Pimco, along with other closed-end fund companies, usually publish something called a UNII report. This report shows how well covered their current dividend is. This has been a large source of concern for people because the coverage for a lot of their funds hasn't been too good this year. One of the biggest concerns has been for PDI. You can see back in April, PDI's dividend coverage was only 68.97% covered. In May, it improved a little bit to 72.9%, but then in July, it dropped all the way down to 52.61% coverage for the year 2023. As of last month, it has improved quite a bit to now 83.33%, but it's still not entirely covered as of right now. The other Pimco funds are around 70 to 90% covered, but the worst is PCM, which is currently at 54.50%. It should be said that a handful of Pimco funds, including PDI, PDO, and PCM, have not cut their dividends since interest rates started increasing. So we'll have to wait and see at the end of this year if they'll still be able to fully cover their monthly distributions. Another point that I think is worth making is that some of these funds have a lot of holdings with very short maturity links. You can see that 37% of the debt held inside a PDI matures in less than 1 year. With interest rates being much higher now compared to a year ago, this means that future debt that some of these funds will take on will come with much higher interest attached to it. So this could potentially mean higher interest income, better dividend coverage, and potentially another special dividend like what happened last year. At the same time though, this can't be guaranteed because if this new debt is more expensive for these companies to borrow, it could also mean more defaults. So it'll depend on the quality of debt that Pimco is able to include in their funds. So to summarize what we've looked at, we're probably still a decent amount of time away from seeing a good recovery in share prices. According to experts, they believe that rates probably won't see a decent cut until the latter half of 2024. It's possible though that these share prices could start to go up more if the market is confident that the Feds aren't going to increase rates any further. But in terms of seeing a substantial recovery in share prices, that's going to require the Feds to lower interest rates. Their safety of their dividends is a different story though. Right now I think that there are reasons to be at least a little bit concerned. Even though Pimco has largely done a good job in picking investments for their funds, the fact that their dividends aren't fully covered is at least a little concerning. We'll see if they can make it through the end of the year and reach full coverage. But even if they don't reach full coverage, this does not guarantee that there will be a dividend cut. They might choose to pay return of capital to cover the difference if it's small, but we'll have to wait and see. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.